Fed has taken remarkable action to support the well-functioning of markets, spending multi-trillions of dollars. Back on February 26, 2020, the Fed's balance sheet was just a little over $4 trillion. The latest data puts the Fed's balance sheet at $7 trillion. And it's not just the rapid ramp-up of asset purchases that is amazing. The Fed is buying certain types of securities, such as municipal bonds and corporate debt, that it has never bought before. A little over half of what the Fed has been buying are U.S. Treasuries. From our perspective, the main rate impact from these purchases comes when the Fed buys long-dated U.S. government debt, say 10-year maturities or longer. Most of the Treasury securities being bought, however, are of less than 10 years maturity. Still, the Fed has purchased over $250 billion of longer-term debt over the last 8 or 9 weeks. The impact of buying long-term debt is to keep the yield from rising even as the U.S. government sets records for its budget deficit and borrowing needs. Essentially, the Fed is managing the yield curve, not necessarily to a target shape, just trying to avoid the potential volatility that could result from such massive budget deficits. Since the Fed anchors the short end of the yield curve with its federal funds rate target, the purchase of shorter-term debt does not additionally impact interest rates, although it does make it easier for the Treasury to finance its deficit. That is, the huge buying of Treasury securities is a tacit adoption of modern monetary theory, or MMT. That's a fusion of fiscal and monetary policy. Regarding the Fed's newfound appetite for municipal and corporate debt, just the announcement that the Fed was going to buy these securities had the impact of reducing credit spreads relative to U.S. Treasuries. So far, the purchases have been small, and they're just getting started. Interestingly, with the Fed influencing credit spreads relative to Treasuries, this means that the credit markets will not reflect the full extent of the damage to corporate balance sheets and to state and local government revenue streams, which might be a good thing. Keeping the credit spreads contained may help these entities raise cash and get through to the rebuilding phase. Although longer-term higher debt loads will be a burden on companies and local governments. The bottom line, the overall size of the Fed's balance sheet is likely to grow further and may never shrink. The Fed buys and holds. It is not a seller. There was no exit strategy when quantitative easing was started the first time. And when the exit did commence, it did not last long. Another point, price discovery in the credit markets has moved into a new phase. The Fed is now a major player, and it has unlimited resources. Then, some will worry that MMT means inflation. For the time being, and that may mean for years, our worry is about deflation due to the massive unemployment. Far down the road, and once the economy is back on track, then it will become interesting to watch for inflation pressures, but not right now with deflation occurring and with the consumer price index dropping each month. I'm Blue Putnam, Chief Economist, CME Group.